We had a bit of a pullback on the markets on Tuesday and going into yesterday morning as well, but it appears that the direction is up again, really.
Yes, I think this is exactly the sort of volatility that has just been alluded to. We started off the market yesterday morning still reeling slightly from the change in China's reserve rate requirement. Maybe just to put that into a little bit of perspective, the Basel II requirement for that reserve ratio is 7.2%. China was already sitting on a very comfortable 16%, and they raised this to 16.5%. So certainly only a marginal increase and quite well ahead of the Basel requirement. So the market did wobble a bit, and we certainly saw a strong pullback in commodity prices and commodity stocks, but with very good news coming out of the US yesterday afternoon and followed on by good news out of Asia this morning, the markets have certainly taken a turn for the better, and we've got some strong positive momentum across all bourses today.
And of course we also saw those jobs figures coming out of Australia this morning, and really in quite a different position to the rest of the world, or quite a lot of the rest of the world at this stage. Nerina, how do you see it out there at the moment? I mean, are we getting more good news than bad news? Is the recovery intact? And is the direction for markets going to be upwards going forward?
Stephen, I'd hesitate to say that the recovery is intact. I think there's still a lot of conflicting data coming out, and I think a lot of it is very tentative. We do continue to get conflicting signals. Some of the economic data that come out is very good, and then it's followed on by some very bad data. So the market does find it difficult to put this into perspective and say, where are we really going? I think probably the most important theme continues to be that as long as money is cheap, these markets will continue to go up. And if there's only one factor that I'm monitoring, it certainly will be the monetary policy, mostly in the US, but also in Europe and the rest of the world, because as far as I'm concerned, that is really what is continue to power the markets ahead, and almost all fundamentals are just ancillary factors to market movement at the moment.
Well, of course, we have seen some countries, most notably Australia and Norway, raising their interest rates already. And of course, China now alluding to that with those raised reserve requirements for banks, which will make it a bit more difficult to lend. I mean, do you see the ECB and the states following suit anytime soon? Of course, we do have that ECB rates announcement this afternoon.
We don't expect them to follow anytime soon, and I think the commentary is probably more important at this stage rather than the actual rate decision. Currently, analysts and market watchers are not expecting the rates to actually start increasing, but the commentary is really what we need to be on the lookout for. And I think any hint of a loosening or tightening in the monetary policy will certainly be taken negatively by the market and say maybe it's time to take some money off the table. So that's what I would be watching at this stage.
Of course, Nerina, we're right at the beginning of the US earnings season. We had those results out on Monday night from Alcoa, which disappointed the market. We're looking for JP Morgan and Intel coming out today. We're also getting US retail sales figures this afternoon. Do you think that there is the possibility that we are going to see more disappointments coming through and more setbacks on the market?
Well, you know, numbers are an interesting factor. When we look at the current earnings growth forecast for the S&P 500 for Q4, it currently stands at a 62% growth Q4 year on year. Now, we must bear in mind that this, of course, comes from a very, very low base in Q4 of 2008. But if you only look at the 62% growth, it looks extremely positive. And unfortunately, over hasty market players might look at this and think that it's up and go and everything is great. I am somewhat concerned about the actual numbers that come through, not necessarily only in the States, but specifically in South Africa. If we also look at our own earnings forecast picture, over the last month we've seen quite strong upgrades in the resources space, most notably from the gold and platinum counters. It's not surprising on the back of the strong commodity prices. I'm a bit concerned about the currency effect, whether that's really been taken into account properly, and depending on how the retrenchment costs have been brought through by the analysts, I'm just a little bit concerned that maybe we might get some negative surprises in our own reporting season when it starts with the gold miners at the end of this month. So certainly a lot to be on the lookout for. I think there's a little bit too much optimism at the moment, and maybe it's time to just be a little bit more cautious until we see some firm numbers coming out that are not bad.
Well, of course, Nerina, for the fourth quarter, we saw the gold price shooting up quite nicely up into mid-December. But as you say, the rand really quite resilient and still holding around those levels as we enter the new year as well.
I think the rand is certainly a reflection of this cheap money worldwide, and investors are looking for yield, and South African investment markets still offer that yield. And I think our strong rand really is a reflection of the good inflows that we've seen into our capital markets and this global hunt for yield. Risk aversion globally is still relatively low, and that's really where we've been the beneficiary of the capital inflows, and one of the main reasons why the rand has been as strong as it is. This could all turn very quickly. I don't want to sound bearish, but I'd rather just sound cautionary and say be aware of these major factors where we have very little control over our own destiny and really are at the mercy of the international decision makers and investors.
Of course, we've already had a taste of some of the results that are going to be coming through from the retail sector. We had trading updates from Shoprite and Massmart yesterday, and then from Mr. Price this morning, and really appearing to be a bit of a mixed bag from those retailers.
Very much so. It is a case of, I guess, the good, the bad and the ugly, with a very clear picture in terms of the spectrum from non-durable, semi-durable and durable goods, showing us very clearly the position that the South African consumer find themselves in. Shoprite on the non-durable side of the spectrum coming out with very, very good numbers, and certainly reflective of a strong growth across all markets. The only negative that they had was on translation losses from their non-rand denominated operations, so not surprising as far as that is concerned, but on a local currency basis, very good growth numbers from them. The slightly worse one, the one that came out this morning, Mr. Price, certainly below expectation, operating mostly in the semi-durable space. About 75% of their sales are in apparel, and interesting to see that they said that 85% of their sales are cash-based. So it clearly shows that credit is certainly not easy to find. Massmart, very disappointing yesterday also, mostly in the durable goods space, the white goods, and unfortunately the South African consumer is just not been in a position yet to take advantage of the strong rand. Imported goods that are probably lower than they've been for a while, the South African consumer is still on the back foot.
Nerina, so really your message would be to approach 2010 with caution if you're an investor.
Absolutely, and I think for me the most important message still remains to be as diversified as you possibly can. Diversified across your asset classes, across your geographies, across your industries, across currencies, because that's really the best defense that you have in volatile markets and in uncertain markets. Unfortunately, because of the cheap money, this is not a time to sit on the sidelines, sit on your hand and not participate when there is positive price momentum. But you need the diversification to balance the high risks that we have out there in the market.